$65 billion. That was the size of the illusion. Bernie Madoff did not look like a scammer. He looked like Wall Street itself. He had reputation. He had status. He had wealthy clients. He had institutional respect. And for years, people trusted him with their money. They believed their investments were safe. They believed the returns were real. They believed the account statements were accurate. But behind the calm image was one of the largest Ponzi schemes in history. There was no magic strategy. There was no secret trading genius. There was no special machine producing steady profits year after year. There was just money coming in from new investors, money going out to old investors, and fake statements that made everyone believe the money was still there. This is the story of Bernie Madoff, a man who built one of the most trusted names in finance, and then used that trust to hide one of the biggest financial frauds the world had ever seen. Before the scandal, Madoff was not an outsider. That is what made the fraud so dangerous. He founded Bernard L. Madoff Investment Securities. He had served as chairman of NASDAQ. He had decades of Wall Street experience. He looked legitimate. To many investors, that was enough. Madoff was not selling a wild dream. He was selling calm. That was the genius of the fraud. He did not promise crazy returns. He did not say investors would double their money overnight. He offered something much more seductive: steady returns, quiet confidence, low drama. The numbers looked smooth, too smooth. Month after month, year after year, investors saw consistent performance. Not explosive, not ridiculous, just steady enough to feel safe. That is why so many people believed it. A massive scam does not always look loud. Sometimes it looks boring. Sometimes it looks respectable. Sometimes it looks like a monthly statement that never scares you. Madoff's supposed strategy was called split strike conversion. That made it sound technical. It made it sound sophisticated. It made it sound like there was a complex trading method behind the returns. But the real mechanism was much simpler. It was a Ponzi scheme. In a Ponzi scheme, money from new investors is used to pay earlier investors. There is no real profit engine. The scam survives as long as enough new money comes in and not too many people ask for their money back at the same time. Investor A puts money in. Investor B puts money in. Investor A wants a withdrawal. The scammer pays Investor A using Investor B's money. Investor A thinks the investment worked. Investor B thinks their money is invested. The scammer sends fake statements to everyone. And the illusion continues. That is what made Madoff so dangerous. People saw withdrawals getting paid, so they thought the money was real. They saw statements showing gains, so they thought the investments were real. They heard wealthy people trusted him, so they thought the operation was real. But the appearance of payment is not proof of profit. In a Ponzi scheme, paying withdrawals is part of the trick. It creates trust. It makes people tell their friends. It makes investors think, I got paid, so it must be real, and that trust brings in more money. Madoff also used exclusivity. Not everyone could invest with him. That made people want access even more. Scarcity is powerful. When something feels hard to get into, people assume it must be valuable. Instead of asking, why is this secret? They ask, how do I get in? That is one of the psychological traps in fraud. The investor feels lucky to be included. And when people feel lucky to be included, they often stop asking enough questions. Madoff's client base included wealthy individuals, charities, foundations, family offices, and institutions. Some people invested directly. Others invested through feeder funds. Those feeder funds collected money from investors and sent it to Madoff. That allowed the fraud to grow even larger. People who may never have met Madoff still became exposed to the scheme. They trusted someone who trusted someone who trusted Madoff. That chain of trust became the pipeline. And the longer the scheme survived, the more legitimate it looked. People thought, if this were fake, someone would have found it by now. If this were fake, regulators would have stopped it. If this were fake, sophisticated investors would have noticed. But that assumption was wrong. Fraud can survive for a long time when the fraudster is trusted. Fraud can survive when people do not want to look foolish. Fraud can survive when returns are not too high, just high enough. And fraud can survive when warning signs are dismissed because the person behind the scheme seems too respected to be lying. There were warning signs. Some people questioned how Madoff produced such consistent returns. Some wondered why the strategy did not match the market. Some noticed the lack of transparency. Some asked how the trades were actually being executed. One of the most famous critics was Harry Markopolos. He repeatedly warned regulators that Madoff's returns did not make sense. But the warnings did not stop the scheme in time. That is one of the most painful parts of the story. The red flags existed. The questions existed. The doubts existed. But the trust around Madoff was stronger than the warnings. And when trust becomes stronger than evidence, fraud has room to grow. Madoff's operation had another major danger. He controlled too much of the process. He created the statements. He claimed to execute the trades. He controlled the information investors saw. That is dangerous. When one person controls the money, the records, and the reporting, investors are vulnerable. Because the person telling you what happened is the same person who benefits if you believe it. That is why independent verification matters. Trust is not a control. Reputation is not a control. A famous name is not a control. In finance, the money has to be verified. The trades have to be verified. The custody has to be verified. Otherwise, investors are only trusting a story. For years, the machine kept working. Money came in. Fake statements went out. Withdrawals were paid. Investors stayed calm. And the illusion grew. But every Ponzi scheme has the same weakness. It needs confidence. As long as investors keep their money in, the scam can survive. But when too many investors ask for money back, the truth comes out. That moment arrived during the 2008 financial crisis. Markets were falling. Fear was everywhere. Investors wanted cash. People started asking for withdrawals. And suddenly, Madoff could not keep up. The money was not there. The profits were not there. The investment account people believed existed was not real in the way they thought. The illusion broke. In December 2008, Bernie Madoff was arrested. The financial world was stunned. The man who had seemed safe, respected, and connected was revealed as the center of a massive fraud. Investors were devastated. Some lost life savings. Charities were damaged. Foundations were hit. Families were destroyed financially. The damage was not just numbers on a screen. It was real people. People who thought they had retirement security. People who thought they had protected wealth. People who thought they had chosen the safe option. That is why the Madoff scandal hurt so deeply. The fraud weaponized trust. It did not lure people with chaos. It lured them with safety. In 2009, Madoff pleaded guilty to multiple federal crimes. He was sentenced to 150 years in prison. The sentence sent a clear message. This was not a small mistake. This was not a failed investment strategy. This was a long-running fraud that destroyed lives. Now let's talk about the psychology. The first psychological force was reputation. Madoff looked credible. He had experience. He had history. He had industry status. People believed the man because the man looked like the system. When someone is seen as part of the establishment, people assume they have been vetted. They assume someone else checked. They assume regulators checked. They assume other investors checked. But assumptions are not due diligence. The second force was consistency. Madoff's returns looked steady. Investors love steady returns. A smooth return pattern feels safe. But real markets are not perfectly smooth. Markets move. Strategies struggle. Volatility happens. When returns are too consistent for too long, investors should ask questions. But psychologically, smooth returns are comforting. They make people relax. They make people feel smart. They make people stop worrying. And that comfort became part of the trap. The third force was exclusivity. People wanted access. If Madoff did not accept everyone, getting in felt special. That made investors less likely to challenge him. They did not want to lose access. They did not want to be pushed out. They did not want to look difficult. Fraudsters often use this. They make the victim feel chosen. They make questions feel like a threat to the relationship. And once the victim feels privileged to participate, the fraudster gains power. The fourth force was social proof. Important people were investing. Wealthy people were investing. Institutions were investing. Funds were investing. Charities were investing. That made the scheme feel safer. People thought, if all these people trust him, maybe I can trust him too. But social proof is not due diligence. A crowd can be wrong. A prestigious network can be wrong. A group of smart people can all rely on the same bad assumption. That is what happened with Madoff. Many investors were not independently verifying the truth. They were trusting the trust of others. There are clear lessons from the Madoff scandal. Lesson 1. Never confuse reputation with verification. A respected person can still commit fraud. A prestigious firm can still lie. A long history does not guarantee honesty. Lesson 2. Smooth returns should be questioned. Markets are messy. If an investment performs too consistently, investors should ask how. Lesson 3. Independent custody matters. The person managing the money should not be the only source proving the money exists. Lesson 4. Secrecy is not sophistication. If the strategy cannot be explained, verified, or audited, that is a warning sign. Lesson 5. Social proof is not due diligence. Just because wealthy people are invested does not mean the investment is real. And the final lesson is the most important. In finance, trust is not enough. Trust feels good. Trust makes decisions easier. Trust reduces fear. But trust without verification is dangerous. Madoff understood that. He did not build the fraud only on fake numbers. He built it on people's need to believe someone safe was protecting their money. That is why the scandal still matters. Because Madoff did not look like danger. He looked like security. He looked like access. He looked like stability. And that image helped hide the truth for years. The money was not being invested the way people believed. The returns were not being generated the way people believed. The statements were not showing reality. The entire structure was an illusion. $65 billion. That was not just a number. It was the size of the trust people placed in him. It was the size of the story people believed. It was the size of the lie. Bernie Madoff turned reputation into a weapon. He turned exclusivity into bait. He turned fake statements into comfort. And he turned investor trust into one of the largest Ponzi schemes in history. That is why Madoff belongs in the corporate collapse library. Not because the mechanism was complicated, but because the trust was so powerful. The scam was simple. The image was sophisticated. And that combination destroyed lives. If you want more corporate collapse, fraud, and financial disaster breakdowns, subscribe to the channel. And watch the next case study, because Madoff was not the only time investors trusted a story that turned out to be fake.